Hello. 라이크 오스피일리 차트 유시나우 더 S&P 500 ETF 마오 키츠 네버 시트스틸. Today we skip metaphors and go straight into the financial engineering every real investor needs. We'll cover four things: how option payoffs work, the danger of leverage, the logic of hedging, and why you should never overtrust a pattern. It looks hard, but the core is one habit. Weigh maximum loss with the same seriousness you weigh upside. No stock tips. No promised returns. We focus on teaching you to read risk. Let's begin. You're looking at Apple's daily chart. Options are tools that trade on top of names like this. Let's lock in two words first. A call gives you the right to buy later at a price you set today. A put gives you the right to sell later at a price you set today. Both are rights, never obligations. Here's a hypothetical. Suppose you buy a call with a $100 strike and pay a $10 premium, about the price of a few fancy coffees, not a life-changing bet. If at expiration, the underlying is at 120, the right to buy at 100 has real value. Subtract the $10 premium and you're ahead. If it finishes below 100, there's no reason to exercise, and your maximum loss is capped at the $10 premium you paid. These are made-up numbers for teaching, not a real trade result. This is GameStop's daily chart. We'll use a real historical episode from 2021 to see what leverage can do. At the time, some retail traders bought the stock and call options together, and option buying was reported to create far larger notional exposure than the shares alone. A single dollar in options could create several to tens of times the stock exposure, amplifying the squeeze, and some hedge funds that were short the name were reported to take heavy losses. There is zero implication here to buy or sell this stock today. Treat it as history only. The lesson is clear. Leverage magnifies losses as well as gains, so size only what you can afford to lose. We're back on Apple, but on the weekly this time. Hedging is how you manage risk on top of a longer trend like this. A classic approach is delta hedging. The option seller holds or shorts the underlying as needed, adjusting the position to offset P&L swings. The Black-Scholes Merton model in 1973 gave this hedging idea its theoretical foundation. The key point: hedging doesn't erase risk. It redistributes it across the market. When that balance breaks, the hedge itself becomes a new risk. Individual investors sometimes buy puts as insurance against a drop in shares they already own. Again, that's a hypothetical use case, not a recommendation to make any specific trade. This is the SPY Weekly, the market most U.S. and global investors watch alongside the Fed and the NASDAQ. Underneath, it sits another huge layer you don't see on the chart. Expert estimates put the global derivatives market at several times the size of the underlying cash markets. Exact figures are estimates, so we stick with several times. In normal times, this market supplies liquidity and risk sharing, which helps keep markets stable. In a crisis, many derivatives can move the same way at once, usually down, and amplify the shock. Stability and instability are both possible. So don't let leverage products dominate your book. Build the habit of reading risk at the whole portfolio level, the same way the Fed watches inflation against its 2% target. Widen the lens to the SPY Monthly. On this long horizon, we'll borrow one historical case that beat the market average. Jim Simons's Renaissance Technologies Medallion Fund is known for outperforming the market average for roughly 30 years, starting in 1988. We won't quote specific returns, and we won't hint that anyone can easily copy it. Historical case only. Here's the paradox. Once a statistical pattern is found and traded, the trading itself gets priced in, the pattern fades, and the market converges back toward efficiency. The practical takeaway: revalidate even strategies that worked in the past and diversify. Never depend on one formula. With the SPY daily still on screen, let's lock today's lesson into a real-world checklist. First, when you buy options, always confirm that maximum loss is limited to the premium you paid. Second, leverage products grow gains and losses. Use only small size you can afford. Third, hedging is insurance, not a profit tool. Keep that distinction sharp. Fourth, no strategy works forever, so revalidate on a schedule and diversify. We can't promise returns, but a principles-first attitude toward the market is the real edge. That's it for today's lecture.